Okay, so hello, my dear future chartered accountants. This is Chinmaya Hegde. I hope my voice is audible and the PPT is visible. We are moving on with the FR upgradation classes. Just a reminder, this is not a substitute for conceptual classes, either for crash course or for regular. This is mainly for the problems which have been added by ICAI in this new study material and RTP, MTP, suggestion answers, etc. This is the purpose. The purpose is to solve these questions. And the material is already available in the Telegram channel. So please make sure that you download the material before you attend these sessions. I hope it is fine and I hope the voice is audible. Let's do this problem now. So we are going to do problems on Ind AS 28, investment in associate, basically for significant influence. So let's read this problem. E Limited holds 25% of voting power of the investee. The balance 75% of the voting power is held by three other investors holding 25%. The decisions about the financing and operating policies of the investee are taken by investor holding the majority of the voting power. Since the other three investors together holds majority voting power, they generally take the decisions without taking the consent of E Limited. Even if E Limited proposes any changes to the financing and operating policies of the investee, the other three investors do not vote in favor of those changes. So in effect, suggestions of E Limited are not considered while taking the decisions relating to the financing and operating policies. Determine whether E Limited has significant influence over the investee. I'll read the question once more. E Limited holds 25% of the voting power in an investee. You have 25% in another company. The balance 75% is held by three other investors, each holding 25%. So basically, this company has four people. You're one of them. There are three more people, everybody having a equal share of 25%. The decisions about the financing and operating policies of the investees are taken by investors holding majority of the voting power. Naturally, the decisions will be taken by majority vote. So whoever has the majority, that decisions will be taken. Since other three investors together hold majority voting power, they generally take decisions without taking the consent of E Limited. Even if E Limited proposes any changes to the financing and operating policies of the investee, the other three investors do not vote in favor of those changes. That typically happens. No, let's say you are having four friends in group, and that one person, poor fellow, will always be bullied. You will never listen to him. Other three people, whatever they say, that only will be done. Either to go to restaurant or to go to picnic or trip or to play some sports. Any this or to go to movie. Anything you decide, this one person opinion will not be taken. It can happen in business also. So limited opinion is never respected. So in effect, the suggestions of E Limited are not considered while taking decisions relating to the financing and operating policies. So determine whether E Limited has significant influence over investee. As usual, what we have to go is, we should not go by rule based. If it was a AS 23 question, I would have told you are having more than 20% influence. Yes, you are having significant influence. you are an associate. I mean, they are an associate, you're an investor. You would have made a decision like that. But here, we have to look at the facts of the case, because Ind AS 28 is not rule based, it is principle based. Now, what does Ind AS 28 tell you? For you to have a significant influence, I mean, for you to say whether you have a significant influence or not, you should look at the history. Do you have the role? You don't have the control for sure because you don't have the majority, but is your 25% holding relevant? Is it having some sort of significance? Is it considered in the decision making relating to the financing and operating policy of the organization? Are you even relevant? Looking at the facts of the case, it does not seem that your opinion is not at all considered. So we can say that you're not having any significant influence. So this is a very subjective term. Based on the situation, we should take a call, and looking at the situation, based on these facts given, they are not having any role while making any policies. Their opinion is also not at all addressed. So we can say that there is no significant influence. Yes, that's what even Institute has given. E Limited is not in a position to have significant influence over investee. So basically, you don't do consolidation as per Ind AS 28. Okay, let's move further. Okay, so next one, M Limited holds 10% of the voting power over investee. The balance 90% of the voting power is held by 9 other investors, each holding 10%. So at this point in time, if I apply the rule based AS 23, you say you have only 20%, not sufficient because you have not reached 20% at this point in time. But Ind AS says you have to go further. Are there any other circumstance which, along with 10%, in some way you will be able to have some sort of influence in the decision making of the organization? Let's read if there is any some circumstances which gives you the position of influencing the decision. The decision about the relevant activities, except decision about the borrowing of the investee, are taken by members holding majority of the voting power. Reasonable. The decision about taking borrowings are required to be taken by unanimous consent of all the investor. Further, decision about taking the borrowings are not the decision that most significantly affects the returns over investee. Determine whether significant influence, I mean, M Limited has significant influence over other investee. Okay. So now the question is 10% sufficient? Maybe, maybe not. Is the requirement of this 10% required in all cases? No, not in all cases, but required in borrowing. So you have some role to play, but it does not require. It does not mean it affects significantly affects the return of the investee. Don't think like that. Borrowing does not significantly affect the returns of the investee. So this unanimous consent and all is not at all relevant. Not like that. That means you are not having a control over the company. If the borrowing has the significant influence, I mean, if borrowing decision influences or have impact of significant returns, that means your consent is must because unanimous consent. So which means it becomes a joint control. unless you give your consent, the decision will not be taken, which is very relevant for the organization to run because it significantly affects the returns. That's not the case. Your consent is not, this decision is not going to affect significantly the returns of the organization. Therefore, you don't have the control, but you definitely have some sort of significance. And because the majority of the vote, and 9 others having 10%. So your 10% is also not having control, but reasonable impact is there, right? Because majority means 6 people should be say yes. So it's not the case that you are always degraded, not like that. Your vote has some value. You may not have control, but you have some sort of value in making decisions. So we say that yes, M Limited has significant influence over the investee. Hope you got it. I'll go further. Next, RS Limited is an entity engaged in the business of pharmaceuticals. It has invested in the share capital of investee XY Limited and is holding 15% of XY Limited's total voting power. So RS Limited is having 15% of the shares of total voting power. So at this point in time, 15% is not really any significant influence because we don't know other factors. Let's see other factors. X Limited is engaged, the investee X Limited is engaged in the business of producing packaging materials for pharmaceutical entities. Okay, they produce packaging materials. One of the incentive for the RS Limited to invest in XY Limited, why are they investing? One of the reason was the fact that XY Limited is engaged in the business of producing the packaging materials, which is also useful for RS Limited. So you're not only an investor, you're also a customer because what XY Limited produce, RS Limited investor would like. It is useful to them as well. Since last many years, XY Limited's 90% of the output is procured by RS Limited. Oh, you are not only investor for 15%, you are a customer of 90% for that organization. So that is almost like you are the whole business for that company. Determine whether RS Limited has significant influence. I think the answer is obvious. Since 90% of the output is procured by RS Limited, XY Limited would be dependent on RS Limited for continuation of its business. Even though it's holding only 15%, it still has a it still has a significant influence over XY Limited. I think it's straightforward answer, right? You're having 15% share in the company, and in addition to that, you are the customer for 90% of the output produced by RS Limited, which means if you're not there, imagine their position. So they have to listen to you. I mean, you're not in a position to control just because you're a customer, but definitely your opinion will not be sidelined. They will consider it. So you don't have a control, but you have a significant influence. Let's go further. R Limited is a tire manufacturing entity. Entity has entered into a technology transfer agreement with another entity, Y Limited. So you're manufacturing, you have entered into an agreement with other company for technology transfer, which is also involved in the business of tire manufacturing. Okay, so R Limited also in tire manufacturing, Y Limited also in tire manufacturing. For technology transfer, you have entered into an agreement. R Limited, an established entity in the business, whereas Y Limited is a relatively new entity. Possible. See, for example, MRF tire manufacturing, Apollo Tires, they are all listed companies because they are having a brand, they are having an establishment, they are having a presence in the market. But some new person who have started may not have all these things, at least technology may not be there. So you have entered into an agreement with them. As per the agreement, R Limited has granted to Y Limited the license to use its technical information and know-how. Basically, your recipe. I mean, you may say whatever technical know-how or your secret process in which you follow your manufacturing activities, which are related to the process of manufacturing of tires. Y Limited is dependent on the technical information and know-how supplied by R Limited because of its lack of expertise and experience in the business, because they are new. Further, R Limited also invested in 10% of the equity share capital of Y Limited, determine whether R Limited has significant influence over Y Limited. Again, this should be straightforward, my dear friends. You are having 10% share, and moreover, the technical know-how which you provided is the essence based on which the other companies able to survive. They are dependent on you. Mind it, you are not controlling them. You are providing the license, you have granted the license based on which the entity is surviving. So whatever you say, they will not follow it. They have their own decisions to make, like how many units to produce, where to start the factory, whom should they sell. So the relevant activity decision, they will only make it. But the primary technical know-how, they are dependent on you. So if you say something, they will consider your opinion for sure. They cannot rule out your opinion. They cannot sideline it. So again, we say that you have a significant influence in spite of having only 10% because of the technical know-how dependency other company has. Okay, let me move further. An entity which is currently holding 10% of the voting power of an entity has an option to purchase additional 15% of the voting power investee from other investor. However, the entity currently does not have financial ability to purchase 15% voting power. Determine whether entity has significant influence over the investee. Okay. In this problem, we don't have any information apart from the data on the voting share, the 10%, 15%, something like that. So when you don't have any other information, we have to make our answer based on only this. Or you can say towards the end, other facts are also to be considered. Because in days 28, in days for that matter, don't focus on rules, it focus on principles. And we have seen some other earlier problems as well, that even though you're having 10%, you still might have said to have a significant influence because of you are the customer, you are the majority customer, or because the companies depend on your technical know-how, things like that. But in this problem, we have information only relating to the voting power, and therefore we should limit our answer to that extent only. And towards the end, maybe you can add a line, other factors also to be considered. Okay, now what is the issue here? What percentage, if you consider only the voting share, what percentage should be considered for you to have a significant influence? That is 20%. You're having 10%, other things remaining constant. Having only 10% will not give you significant influence. Other things remaining constant. But here you're having one more point. You're having an additional, you're having an option to purchase additional 15%. So if you purchase 15%, then it becomes a 25%. Then you will have a voting power. When you more than 20%, in that case, you will have a significant influence. So question here is, should I consider potential voting rights. To assess significant influence, should I consider potential voting rights? Similar situation is there in Ind AS 110 to establish the control. Do you remember when you establish a holding subsidiary relationship, you consider potential voting rights? Do you remember? A similar concept is there in Ind AS 116 lease as well. That is, protective rights are not considered, substantive rights are considered. So, potential substantive rights are considered in Ind AS 110. What is substantive rights? I will not go behind that. Just 1 second. Okay, fine. So, substantive rights are 1 second. Okay. Now, so substantive rights are now considered in Ind AS 110 for making a decision whether to include potential voting rights. Does that situation has, or does that clause exist in Ind AS 28? Should potential voting rights be considered only if it is substantive in nature? Anything like that? Let's read the solution. Considering the potential voting rights, the entity will have more than 20% because 10 plus 15 it becomes 25 of the voting power of the investee, and hence it is presumed that entity has significant influence over the investee. The fact that, focus here, the fact that entity does not have financial ability to purchase such voting power is not considered in such assessment. It should be noted that under Ind AS 110, potential voting rights which entity cannot be exercised because of financial ability are not considered as substantive and hence not factored in assessment. However, in DES 28, there is no such requirement given, and hence potential voting right, even if they are not substantive as per INDES 110, are included in the assessment of significant influence. So, what does the INDES 110 says? Potential voting rights to be considered only if it is substantive, means it's possible. Entity is in a position. The option price should not be deeply out of the money. The entity should have the financial ability to purchase. Basically, it should be possible enough to purchase the potential voting power. It should be possible. It should be realistic. It should be pragmatic. It should be reasonable to exercise the option. Then it becomes substantive. Then you consider in Index 110 for determining the voting power, for determining the control. But in Index 28, such substantive word is not given. So any option, whether entity is in a position to purchase or not, whether it is substantive or not, potential voting power also to be considered for taking a decision whether you're having significant influence. So 10% plus 10%, 15 more, so you'll have 15% voting power, 25% voting power. So you set to have a significant influence. But while doing consolidation, we take only 10%. Because at present profits you're sharing only for 10%, but significant influence determination we consider 25%. So you just consider as investee, I mean it's considered as an associate. Hope you got the point. One is to determine significant influence, the other is actually to do consolidation. For consolidation we don't take voting power, I mean potential voting power, we take only the existing one. Okay, hope you got the point. I'll go further. Okay, next one. On first day of the financial year, A Limited invested in equity share capital of B Limited at a cost of 1 lakh to acquire 25% of the voting power of B Limited. A Limited has concluded B Limited is an associate of A Limited. At the end of the year, B Limited earned a profit of 10,000, other comprehensive of income of 2,000 that year. B Limited also declared a dividend to the extent of 4,000, passed necessary journal entries in the books of A Limited to account for investment in associates. Okay. First of all, you have to understand the accounting in separate financial statements and accounting in consolidated financial statements. Okay. They have not asked both. So in the exam you can go for only consolidated financial statements, but I am giving you for both. So in separate financial statements, you're going to consider it as an investment. I mean, of course, in the books of A Limited. So you're going to pass investment in B Limited at a cost of 1 lakh, investment in B 1 lakh, to bank 1 lakh. Okay. Now, this investment can be valued as per Ind AS 109, Ind AS 32109, or it can be valued as per Ind AS 27. If you value as per Ind AS 109, you should go for fair value, either fair value through P&L account or fair value through OCI. Or if you follow as per Ind AS 27, because anyway you're going to do consolidation, so Ind AS 21 say you can value them as per cost. Because anyway consolidation is going to be done, you don't have to worry about the fair valuation part. This is the choice, the decision the entity has to make. But anyway, this portion they have not asked in the problem. You need not represent this in examination. I told you only for your reference. We will do only in consolidated financial statement. In the books of A Limited, when nothing is mentioned, we'll take it as in consolidated financial statement. They're also going to pass investment amount because you don't recognize their net assets in your company, it's not a subsidiary. So you will pass investment in B Limited 1 lakh to bank 1 lakh. Same entry you will pass. But at the end of the year, we follow equity method of accounting. What is equity method of accounting? Like a partner versus partnership. So when a partner gives the money to partnership, for the partner, it is investment. And when at the end of the year a profit comes, you will not wait for the profit to be withdrawn by you. You'll always account for your share of profit. The profit in the books of partnership firm will automatically be transferred to partner's capital account. Their share of profit, whether they withdraw or not, that is the same way we follow in equity method of accounting. The company will recognize the profit and the investor will recognize the profit, their share of profit on accrual basis. Equity method of accounting. And one more point, this investment amount will include goodwill. When you invest in associate, you will have ownership of goodwill, but you don't show it separately. It is implicit. You will show it in the notes to accounts as an additional information. Anyway, in this problem, we don't have information regarding net assets and all. So we can't compute goodwill, but does not make difference with respect to journal entry. For reporting purpose, this investment includes net assets of associate a share of net asset of associate as on date of acquisition, and goodwill proportionately to that extent. Okay, and what is equity method? We recognize investment at cost, then we increase it by our share of profit. Investment account debit to P and L, and respectively, what is respectively? The associate P and L, I will have a share. Associate other income, I will have a share. So, however, associate reports their profit, I will share their respective profits. So, A Limited at the end of the year earned a profit of 10,000. Sorry, B Limited earned a profit of 10,000. So associate made a profit 10,000. Investor will take a share in that. Entry is going to be investment in B Limited, which is your share 10,000. Your share 25% means 2,500. And share in what? In the profits of the organizations. So to P and L. 2,500. So, however, the associate reports its profit, correspondingly, investor also should report the profits. The associate B Limited reported as P and L, you also are transferring your share to P and L. Then other comprehensive income of 2,000. So associate reported other comprehensive income of 2,000. The investor also will report other comprehensive income to the extent of your share. Entry will be investment in B Limited to OCI. 2000, 25% means 500. 2000, your share 500. Now, when the associate transfer OCI to reserves and surplus, either directly or indirectly, you have with recycling, without recycling. Same process, the investment investor also should do it. Whenever OCI is taken to P and L, you also take the OCI to P and L. If it remains as OCI in the books of associate, investor also should keep it as OCI only, which is what done here. Then declared the dividend, assume it is declared and paid, because for declaration dividend, no cash flow will take place. So I assume that it is declared and paid subsequently. For that, I am passing an entry. It is dividend income or receivable, let's say receivable. So that's going to be uh, dividend income receivable, dividend receivable, or if it is received cash account, you debit it. Dividend receivable to investment in B Limited. Dividend receivable to investment in B Limited. 4,000 dividend, you are say 25%. 4,000 25% means thousands. 4,000 25% means thousands. So that's the nature of equity. In equity method of investing, equity method of reporting. When income is earned, you add to investments. When dividend is declared and paid, you subtract from investments. Normally, you take dividend to P and L account. But here, why are you taking to investment account? Answer is very simple. When you recognize the income as your share, you have taken the investment account to P&L account, which means you have recognized the income on accrual basis. Investment account debit to P&L account, share of profit from associate. You have recognized income on accrual basis. Now, when dividend is paid out of that income, if you again take it to P&L, it is obviously duplication. So, it is subtracted from investments. Investment account debit to P&L, income recognized, investment debited as a receivable. And when you receive it, the investment will come down. It is just like a partner withdrawing his share of profit from the partnership firm. So, when the profit is earned, what entry you pass in the books of partnership firm? P&L account debit to partner's capital. Partner's capital increased. And when partner withdraw money, the capital balance will reduce. In the books of company also same thing happens. When company earns money, the reserve and surplus will increase, net worth of the company will increase. And when dividend is paid out, it's like paying the share of profit to them. Cash is paid out. What will happen? Reserve surplus. Reserve surplus will come down. In the books of investor, what will happen? In the books of partner, what will happen? When a share of profit comes, he will pass an entry, investment in partnership to P&L for share of profit for income earned. And when you withdraw your share of profit, what will happen? The cash account to investment will reduce. The same way, equity method accounting is very simple. When the associate makes a profit, your share of profit you add on accrual basis, investment account debit to P&L. Investment represents receivable, P&L represents income, accrued income. And when you actually receive it, you don't take it to P&L, you just reduce from investments, because investment, it was already added, now you received, so it is being subtracted in investments. Hope you got two simple points. Dividend not taken to P&L because it was already recognized on accrual basis. And second point, it is subtracted from investments. It is credited to investment because earlier it was added, now it is subtracted, so that that effect is given. Hope you understand. That's all about this problem. Okay, very good. I hope no doubts on this one. Equity method of accounting. Goodwill is not shown separately minded. It is part of cost of investments. Okay, hope you got it. I will go further. Okay, next. MNO holds 15% of the voting power of DEF. PQR Limited, which is subsidiary of MNO Limited, also holds 10% voting power of DF. Hence, MNO Limited has total 25% voting power of DF Limited. How 25%? 15% directly and 10% through subsidiary. I have 15% directly. Another one, I have a subsidiary. Subsidiary has 10%, directly 15%, through subsidiary 10%. Total voting power 25%. And accordingly, a significant influence. How should MNO Limited account for investment in DF in consolidated financial statements? Okay, so you're having direct holding of 15% and indirect holding of 10%. So basically, direct holding you can apply Ind AS 27 in separate financial statements. Ind AS 28 in consolidated financial statement. Ind AS 28 means you follow equity method of accounting. What is equity method? I hope I've explained earlier. The share of profit is added based on accrual basis, and when you receive in the form of dividend, that is subtracted. That is what is uh, equity method of accounting. You're having a voting power directly. But what you're having DF Limited is through mutual fund, which is PQR mutual fund, with subsidiary of MLO Limited. Because you're investing through another company, you can also follow equity method, but they're also mutual fund, they're investment entity also. So you can avail exemption by applying equity method to 10% and instead measure investment fair value through P&L account. Means that 10% what you're having through subsidiary, you can follow, you can avail exemption. You can do Ind AS 28 equity method, but they're investment entity. So what we can do, instead of following the equity method, you can avail exemption. You can avail exemption by following fair value method as per Ind AS 109 for two reasons. One, it is through subsidiary, and second, it is investment entity. You can claim the fair value exemption. Hope you got the point, and that's what solution also says. I will go further. Blue Limited acquires 25% of the share capital of Green Limited on the first day of the financial year, 1,25,000. As on that date, carrying value of net assets of Green Limited was 3 lakh and the fair value is 4 lakh. What does it signify? In the separate financial statements and in the consolidated financial statements, on the date of acquisition, you will value investment at cost. But in the consolidated statements, while reporting, the cost is broken down into two parts: net assets of the company on the date of organization, net asset of associate, and the proportionate goodwill included therein. Only for reporting, not for recognition, only for disclosure, not for representation in balance sheet. So 1,25,000 you paid, but to be broken down, how much is net assets of the company and how much is the proportionate goodwill included in that cost of investment, where it is being shown in consolidated financial statements and not in separate financial statements. The excess of the fair value over the carrying value was attributable to one of the building owned by Green Limited having a remaining useful life of 20 years. Green Limited earned a profit of 40,000 and other comprehensive income of 10,000 during the year. Calculate the goodwill capital reserve on the date of acquisition. Blue Limited's share profits and other comprehensive income for the year and closing balance of investment in that year. Okay, fine. Okay. Calculate the goodwill or capital reserve. Okay, how do you calculate goodwill? Two simple formula. Whatever is the cost of investment. So as on date of acquisition, cost of investment is how much? 1,25,000 less share of net assets, proportionate share of net assets. Share of net assets. How much is net assets? Carrying value is 3 lakh, fair value is 4 lakh. Of course, we should take fair value 4 lakh and your share 25%, which is 1 lakh. Therefore, on the date of acquisition, goodwill 25,000. This goodwill is not shown as intangible assets in consolidated financial statements. It's not an intangible asset, not shown as goodwill. In the cost of investment, includes goodwill of 25,000 only for disclosure purpose. And then on the profit of 40,000, that whatever the profit earned by the associate, a proportionate share will be shown in the books of investor. And in the same nature, if associate share it as profit and loss account, investor also will report as P&L. If associate will report as OCI, the investor also will report as OCI. So what we are going to do? So I'll do it in the next slide. Cost of investment 1,25,000 and within brackets you tell including goodwill. Including goodwill. Then you add share of net profits, share of P&L. from associate. Then you add share of OCI, the respective nature. Of course, it will be added. P and the investment account debit to OCI. You should show separately. Then subtract if you receive any dividend income. Dividend received, if any. Uh, we follow equity method of accounting. Income is added on accrual basis. When you receive in the form of dividend, subtracted. And you further add fair value adjustments. What is a fair value adjustments? Again, it requires a little bit of flashback of consolidation. I'm not going too much into it. Hope you remember it. If not, go and revise it. Fair value adjustment, revaluation is an item of pre-acquisition profits. If you remember in our columnar format, we distribute into the goodwill column and we take it to the NCI column. But whenever there is revaluation profit and subsequently there will be depreciation because when the value of the asset increases subsequently, you will have a incremental depreciation. You will have a additional depreciation. Means that will reduce the profits. In which column you take? Con PL and NCI. Hope you remember that. So whenever there is an appreciation on the date of acquisition, subsequently there will be an incremental depreciation. So same thing here also we should give the effect. Book value was carrying value was 3 lakh, fair value is 4 lakh, which means 1 lakh appreciation, and this is attributable to building having a life for 20 years. So 1 lakh is the revaluation profit, but to be spread across over 20 years. So adjustments of fair value adjustment or depreciation, additional depreciation, incremental depreciation. So I'll just, or you can say you could have subtract here itself. So institute says P and L adjusted, or I'll just show it here. I'll subtract here share of incremental depreciation. Okay. So share of P and L accounts. Cost of investment 1,25,000. They earned a P and L account, earned a profit of 40,000. Your share at 25%, 10,000. Actually, I write inner column here 10,000. I'll show you why. Incremental depreciation 4 lakh to 3 lakh means 1 lakh. Spread across 10 20 years, so divide by 20, your share 25%. So 1 lakh by 20 means 5,000 to 25%, 1250, and subtracted, okay, minus 1,250. You can write the amount on net effect basis. So 10,000 minus 1,250, 8,750. Institute calls this as adjusted P&L account. P&L 10,000, increment depreciation adjusted 1,250, net 8,750. They say share of P&L adjusted, share of adjusted P&L account. That's what they should use the term, but you can show like this. That's also fine. Share of OCI. OCI is 10,000, 25%, 2,500. Nothing, no dividend received during the year. So the closing balance to be reported in as consolidated financial statements. Closing balance in consolidated financial statements. 1,25,000, 8,750, 2,500, 1,36,250. 1,36,250. Okay, so hope you understood. Any doubts? Okay, I'll go further. KL Limited has invested 50% of the voting power in a joint venture of ML Limited. ML Limited also issued 10% cumulative preference shares to other investors worth 110 lakh. During the year, ML Limited earned a profit of 4 lakh. ML Limited not declared any dividend on the preference share for the current year. Calculate KL Limited share of net profits in ML Limited for the year. So there is a preference shares, and when nothing is specified, it is cumulative preference shares. So as an investor, your share will be after subtracting preference share dividends, cumulative preference shares, and that is the reason. Therefore, profit is 4 lakh, cumulative preference share dividend 1 lakh. So if you subtract 1 lakh, you get remaining 3 lakh, and your share of 3 lakh, you are having a 50% voting power. So as a shareholder, you are eligible for 1 lakh 50,000. So that is your share of profit. Simple point here. So the only point to be kept in mind is when you recognize share of profit from associate, it should be after allowing for preference share dividend, if not provided earlier. That was the only point here. Nothing great about this. Hope you got this. Okay, I'll go further. Okay, next. M Limited has invested 40% share capital of N Limited, and hence N Limited is an associate of M Limited. During the year, N Limited sold inventory to M Limited for a value of 10 lakh. This included 10% of the transaction price profit of 1 lakh. On the above inventory, M Limited sold inventory of 6 lakh to outsiders, and hence inventory of 4 lakh purchased from M Limited is still lying in M Limited. Determine unrealized profit to be eliminated in the above transaction. Scenario B, assume the same facts in scenario A except inventory sold by M Limited to N Limited, and instead of N Limited selling to M Limited. Determine the unrealized profit to be eliminated in the above transaction. Just give me 1 minute. Okay. Uh, Okay, so situation is very simple. This concept is the unrealized profit inventory. So you know it. So let me show it in the form of a chart. So M Limited is the investor. M Limited is the investor, and N Limited is the investee, which is the associate. And who has sold to whom? N Limited is an associate of M Limited, correct? Sold inventory to M Limited. So N Limited sold inventory. Sold inventory. So that means M Limited purchased. What is the value? 10 lakh. and profit of 1 lakh. So value is 10 lakh, which includes a profit of 1 lakh. Okay, fine. On the out of the above, M Limited sold inventory of 6 lakh to outside customers, and hence the inventory of 4 lakh is still lying. So out of this 10 lakh, M Limited sold 6 lakh, unsold 4 lakh. Fine. Now unsold 6 lakh, 10% profit means 60,000. Unsold 40,000, 10% profit means 40,000. 60 plus 40 equals to 1 lakh. Okay. Now can I ask you one question? See if you can answer it. This profit of 1 lakh is included in which P&L account? Did you get my question? This 10,000 profit, is it included in P&L account of M Limited, or is it included in P&L of N Limited? What do you think? It is included in P&L of seller or in the books of buyer? Obviously in the books of seller, right? So if you think from N Limited P&L, this will include 10,000. Okay, this includes 10,000. Now from the group point of view, when you think in consolidated financial statement, because the 6 lakh is sold to outsider, this 60,000 is realized profit. Of course, it is P&L of N Limited including 1 lakh is realized because sold to outsider. But this 40,000 is shown in the P&L account of N Limited as a profit made within the entity, within the organization, within the group. So N Limited is a profit, but for the group, it's not a profit. It is unrealized profit. Unrealized profit. Get the point? This need to be reversed, removed from inventory, which means when M Limited passes the entry as per equity method, what entry does M Limited pass? M Limited will pass investment account debit to P&L. How much? We don't have other information, only about this amount, which is 10,000, but your share, you don't take entire 10,000. Your share 40%. So 10,000, 40%. 10,000, 40%, which is 4,000. So investment account debit to P&L, you will take 4,000. Sorry, 40,000, sorry, 1 lakh into 40%. 40,000, sorry, 40,000, okay. 40% means 40,000, okay, sorry. So 1 lakh into 40%, 40,000 investment account to P&L, your share of profit. And you need to remove 60,000 is okay, but you need to, out of this 40,000, your share to be removed. And where to be removed? Removed from inventory. So your share 40,000 into 40%, which is 4,000. Entry will be P&L account debit to inventory. It would have been included as a part of your inventory to be reduced. P&L to inventory 4,000. No, sorry, not 4,000. 16,000. 40 into 40%. 16,000. 16,000. Hope you got the journal entry. Regular profit you recognize, investment account to P&L account, your share of profit of the organization. Their P&L account becomes your P&L account. But out of that P&L account, there is some unrealized profit which needs to be removed. So debit the P&L account and create the inventory. It could have been taken to the inventory value or inventory investments. Uh, yeah, I think inventory. Uh, Maybe investment is also fine, I think, because their inventory will not become your inventory. Institute has sold inventory. I think I will say investment only. To investment. No, sorry. Inventory is correct. Inventory is correct. Inventory is correct because your inventory will be there. No, your inventory 40,000 because they're in your stock. Yes, inventory is correct. Your stock will be there. Your stock will be reduced by this extent in the consolidated statements. Correct. P&L to inventory 60,000. And later, when you sell this inventory to outsider, this profit will be added to your P&L account. You will recognize basically this entry will be reversed. Hope you got the points. Okay. What would happen if the reverse situation, instead of M limited selling to an N instead of associate selling, if investor only sells, overall situation is same only, right? Out of 1 lakh total profit, realized profit is 60,000, unrealized profit is 16,000. I mean 40,000. Your share becomes 16,000. So here you will not pass an entry investment account to P&L because you have made the profit initially itself. What entry you would have passed initially? You would have passed whatever cash account debit, unlimited. No, you would have whatever it is, unlimited account debit. I'll just take it in a separate slide. Okay, so if unlimited, unlimited, and if unlimited has sold, so on sales, what you would have done? On sales, you would have passed an entry like say maybe cash account or unlimited account. I don't know whether cash is great sales, unlimited account debit. Uh, Transaction price of 1 lakh, 10 lakh value. So unlimited 10 lakh uh, to sales 10 lakh. That's what you would have profit, and you would have a cost also. P&L you would have transferred cost of material, whatever it is. Entry is the debtor account to sales account. Now, at the end of the year, to remove this effect, what should be done? At the end of the year, to remove unrealized profit, this sales should be reversed. Sales account should be reversed. How much sales amount? Which is unsold. Unsold sales is 4 lakh. Unsold sales 4 lakh, and your share 40%, 1 lakh 60,000. So sales account debit 1 lakh 60,000. What is this? Investor share of sales in unrealized profit. Investor share of sales which is unsold. Which is unsold. Remember, this entry was not happening earlier because it is impact is same, but depends on whether investor selling it to associate selling it to investor. Associate selling to investor means it will be in the books of sales of investor, which we are not accounting, we are not consolidating, we are just accounting, we are bringing their investment into our books. So inventory was adjusted sufficient. But now, investor selling it to associate, that means investor sales will be affected. So correspondingly, I am giving the effect. So sales account to cost of materials or purchases to P&L account, or not to P&L, not to P&L, to investments. Investment will be reduced to that extent. Investment in associate in N Limited. Share of unrealized profit was how much? 40,000, 40%, 16,000. 16,000, and cost of material will be balancing figure, or 90% you can say 1,44,000. So investment account is reduced by 16,000. And in case of associate selling, inventory reduced by 16,000. I hope you understood the impacts. Effectively, your P&L account is getting adjusted, right? 1,60,000 sales getting reduced, 1,44,000 cost of metal getting reduced. So, in effect entry, if you want effective entry for understanding purpose, reporting in this entry is correct. Effectively, it is P&L account debit to investments. Simple concept here. What is your profit? 1 lakh. Where is it is taken to? Because it is sold by M Limited. It is in the P&L account of seller, P&L account of M Limited. Now, P&L account of M Limited should be taken out, should be reduced. How much? 16,000 unrealized profit share, 40,000 into 40%. And where do you take it to? You subtract from investments. That's all. And when you actually sell in the next year, this will be reversed. Investment to P&L, that profit will be realized profit then. Hope you got the point. Okay, I'll go further. X Limited has been invested in a joint venture Y Limited by holding 50% of the equity capital. During the year, X Limited sold an asset to Y Limited at a market value of 8 lakh. The asset's carrying value of the books was 10 lakh. Determine how X Limited account for the sale in the books, transaction books. Assume the same facts as per scenario is, except the asset is sold by Y Limited to X Limited instead of X selling it to Y. Determine how should X Limited account for the above transaction in the books. Very similar actually to the previous problem where it was inventory. Here it is asset. Let me show you the impact. Okay, X Limited invested in joint venture of Y Limited by okay. X Limited sold to Y Limited. So X Limited is the investor, Y is the joint venture. And what entry would have passed at the time of sale? During the sale, entry would have been like a Y Limited account debits, uh, market value book Y Limited account debit 10 lakhs, sold for 8 lakhs, loss on sale 2 lakh, to asset 10 lakh. Okay. They would have passed an entry asset account debit to X Limited 8 lakhs. So that 8 lakh gets cancelled. The question is this: should this 2 lakh be reversed? I mean, either Y Limited account debit or bank account debit, does not matter. Now, the question is this: is this unrealized profit? Is this unrealized profit? If you think normally, yes, it is unrealized profit. You have not sold to outsider, so it's not actual realized profit, unrealized loss. So it feels like yes, we should reverse, not entire 2 lakh. Our share of 50% should be reversed by adjusting investment account. But this is a different case. Why? Because even if you reverse by investment, that's okay. Because market value declined, this would amount to impairments. So even if the sale was not done, you still would have reduced because of impairment. So this loss is not to be accounted as unrealized. Now, is this unrealized? Yes, but not reversed. But not reversed because it would have anyway be accounted as an impairment. So what would have happened if it was a profit? Yes, if it was a profit, I would have removed by adjusting the asset account and with the profit amount. I would have adjusted, or P&L account, wherever I would have taken to. I would have adjusted. But or asset account to profit, that would have been adjusted, reversed. But loss, even though unrealized, not reversed, because it is anyway would have been accounted as impairment loss. Interesting one. New problems. I hope you got it. Okay. Scenario B. Assume the same facts in above except the asset is sold by Y Limited to X Limited. Same case also, there also it would have been unrealized loss, but unrealized loss we won't eliminate because the impairment would have been there. Entry would be slightly different because you are purchasing the asset. So asset account debit 8 lakh, you paid 8 lakh, and they made a loss of 2 lakh, their share of loss you will recognize. So if it is Y selling it to X on sale, I mean on purchase actually, X Limited will pass an entry asset account debit to cash or to Y Limited, depends on whether cash or trade transaction, 8 lakh. And at the end of the year, you are going to recognize share of loss. So P&L account debit to investment. How much was the loss? 2 lakh is the loss, your share of loss. 2 lakh into 50%, which is 1 lakh. If it is a profit, what would happen? You recognize the profit, then you reverse the profit, telling it is unrealized. Hope you got the point. So P&L to investment, share of loss. 2 lakh was loss. 50% share means 1 lakh. Okay, I'll go further. There is one more problem before this, maybe in the material, big problem, but that I've already solved it in the YouTube. I already uploaded the solution. A big solution was there. I've discussed already in detail. The video is already available in the YouTube channel. In my YouTube channel, you should be able to get that. So you can search for that. Now let us do this problem. Next problem. Okay. CD Limited held 50% voting power of RS Limited, which is a joint venture of CD. CD Limited's carrying value of investment is 1 lakh. Now, out of 50% stake, CD Limited sold 20% to a third party for a consideration of 80,000. The fair value of retained 30% interest 1 lakh 20. Determine how much gain or loss should be recorded in the books of in the recording profit loss of CD Limited. Okay, effect is very simple. Water money comes in, debited. Carrying amount of investment should be, remaining investment should be revised, and any book value comparison, you should recognize the profit. So you sold for 80,000, fair value is 1 lakh 20, so 2 lakh is the total, book value is 1 lakh, so you make a profit of 1 lakh. Okay, I'll show the calculations so that it will be more easier for you to understand. Okay, so carrying value is 1 lakh, correct? Carrying value 1 lakh. Okay, some percentage is sold, some percentage is retained. You had 50%, then 20% is sold, 30% retained. Okay, you had 50%, 20% is sold, 30% is retained. How much 20% is sold? Don't do 20% of 1 lakh. 1 lakh represents 50. So do in the ratio of 2 is to 3, 20, 30. So 1 lakh into 2 by 5, or 20 by 50. You get 40,000 carrying value. And retained carrying value 60,000. 1 lakh into 30 by 50. Sold for sale consideration 80,000. So you have a gain of 40, gain on sale. And this is the fair value, retained amount fair value 1,20,000, which means gain on revaluation 60,000. Total 60 plus 40, 1 lakh. Total gain of 1 lakh. Or you can simply do carrying sale value 80,000, fair value 1,20,000, 1,20,000 plus 80 is 2 lakh, 2 lakh minus 1 lakh is 1 lakh. You can tell like that also. Simple one. Take it quickly. Okay, next. Ram Limited holds 50% of equity share capital of Sham Limited. The balance 50% of the equity is held by another investor. Ram Limited has joint control over Sham Limited, and it's a joint venture of Ram Limited accounted using equity method. Now, Ram Limited is planning to sell 10% of the share capital to a third party. Such 10% investment meets the criteria of an asset held for sale and has been measured and disclosed accordingly. Now determine how should Ram Limited account for 40% interest retained in Sham Limited. The question is this: when you have 50%, you have a joint control. You account as per equity method. So when you sell 10%, 40%, does it mean you still have joint control? We don't know. Does it have significant influence? Maybe yes, but we don't know the clarity yet. So what the institute tells is like this: till the time 10% is sold, yet to be sold, it should be accounted for retained interest of 40% as equity methods. You still have the control. After the sale of 10%, it still has a joint control over Sham Limited, maybe through contract arrangement. It's if okay, if Ram Limited still has joint control, it should continue to remeasure the investment using equity method. Even after sale, If it is still having joint control, then you can go for equity method. However, if Ram Limited is not going to have joint control over disposal of 10%, then the retained investment of 40% shall be accounted as per Ind AS 109. Of course, that is in separate finance statements. In consolidated finance statements, you still follow equity method only, because it may not be joint venture, but it might have significant influence. So 40% might be significant influence. So you can add one more line. If joint control does not exist, I mean, if joint control still continue to exist, you can say it will be accounted as per equity method. If joint control not exist, if significant influence exists, still continue as per equity method. If joint control is also not there, significant influence also not there, then you account as per Ind AS 109. Maybe you can add one more line, that will be more complete in my opinion. Okay, hope you got it. I'll go further. Entity H holds 20% equity interest in entity S and associate that in turns as 100% equity interest in entity T. Entity S has recognized the net assets relating to entity T of 10,000 in consolidated statements. Entity S sells 20% of its interest to entity T to a third party non-controlling shareholder for rupees 3,000 and recognize this transaction as an equity transaction in accordance with the provisions of Ind AS 110, resulting in a great entity credit in entity's equity of 1,000. The financial statements of entity H and entity S are summarized as follows before and after the transaction. Before, estimated the consolidated financial statements, assets, investments, liability, equity, total estimated the consolidated financial statements, assets from T, liability, equity. Financial statement of estimated after transaction is summarized below. Assets, cash, assets from T, cash total, liabilities, equity transaction, impact with non-controlling interest, equity attributable to owners, non-controlling interest total, although it's limited, did not participate in the transaction. Entity H limited share of net assets in entity S. As a result of sale of 20% interest in T, effectively H limited share in S limited now show 2,200, 20% of 11,000, that is 200 in addition to its previous share. How this equity transaction to be accounted in the first statements of entity S reflected in consumer statements of entity H that uses the equity method to account for investment in entity S. I am really not sure what you understood, what you not understood. I'll give you 2 minutes. Read the problem once more. Let's see what you can understand. Then let me explain slowly. So go through it. Okay. Okay, I'll give 1 more minute. Go through it. Okay. Let me explain you now. Let's understand the structure first. Entity H holds 20% in entity S. Okay. So we have entity H. Then we have entity S. Entity H has 20% in entity S. Okay. So entity H has 20% in entity S. And that in turn has 100% in entity T. So this has shareholding in entity T, subsidiary. Okay. So entity S for entity H is an associate and entity T for entity S is a subsidiary. Hope you are clear with the basic structure. Okay. Now what happened? Entity S has recognized net assets relating to entity T 10,000 in the consolidated financial statements between S and T, between these two companies, between S and T, they have recognized net assets of 10,000. So, entity T had net assets of 10,000. Let me read the full form. Net assets of 10,000. And because entity X is a consolidated financial statements, so they consolidated S Limited's consolidated financial statements. I'll say CFS. What does has we already having it? S Limited's financial statement is what? Assets from T 10,000, equity 10,000. Fine. Cash flow statements will show like this when you prepare the balance sheet. Consolidated statements, balance sheet. They have equity share capital. Let's say equity, net assets, equity 1 lakh, 10,000. 10,000. Okay. Assets, net assets from T, from subsidiary is a 10,000 because 100% consolidation, and equity is a 10,000, and NCI is 0 because 100% ownership. NCI is 0. Of course, NCI is not shown here, but for your reference purpose, consolidated statements mean NCI should come. It's not coming because 100% subsidiary. Everything is owned by entity S itself. Okay, this is full consolidation. Now, how will you report in entity H books? So, when you consolidate like this, when you consolidate the full part, they follow equity method. What you follow equity method? The entity S, whatever the consolidated statements are there, that is taken over by entity H equity method. So what will they show? Consolidated financial statements of entity H will be equity method, right? They follow equity method. They will have their assets and entity S assets. So, but you don't show entity S assets. You will show investment in entity S, equity method, 20% share, significant influence. So this 10,000 is there, you will show 20% share, 2,000. And your assets will be there, nothing is there. And your equity, everything will be there, no other information. So let's say that's equal to 2,000, and that's what they have shown here already. Are you able to get the link of this process correctly? Entity head, entity T, net assets 10,000. That is entirely taken by entity S with NCI being 0. And entity S net assets 20% share is shown in entity H as equity method of accounting. Hope you understood now what is the present situation and the present structure. Okay, moving forward. What is happening? Entity S sells 20% of its interest in entity 2 to a third party for 3,000. So entity S is there, right? Entity S is selling its 20% share. That is also 20%. Selling 20%, that means retaining 80%. Can you please tell me now what would be the impact in consolidated financial statements? I don't want full profit or loss. I want an answer. What will happen to this 20% now? Who or what do you call the 20% of the people as? Can you tell me? What do you call that 20% of the people as? I don't know whether you understand. Those people are now called as non-controlling interest. Just now I told you NCI 0 because entity S having 100% ownership, fully owned subsidiary. Out of 100%, you have given up 20% to somebody else, means you still have 80%. Outsiders are 20%. They don't have control, so they are called as non-controlling interest. Your NCI will reflect now non-controlling interest. How much NCI you sold for? No, sold for, don't worry. What is the amount it should reflect? You sold for 20%, right? Correct, 20%. So what should this become now? This becomes 2,000. This is 10,000. But you sold for cash. So cash will come. You sold for cash 3,000. Sold for 3,000, right? Sold for 3,000. Okay. Now what will happen to the equity now? What is the book value? 2,000. How much is sold for? 3,000. So 1,000 profit, right? Profit. P&L. Profit. 1,000. So how this balance sheet will look like now? Cash 3,000 on the asset side. Net assets will remain same 10,000 because cash is your cash, not entity cash. Then equally 10,000 will continue. NCA will now come for 2,000, 20% of 10,000 and a profit of 1,000 because 2,000 worth NCI sold for 3,000. You made a profit of 1,000, which is what shown already. Yeah. Look at this balance sheet. 10,000 asset, your cash, your asset, 10,000 existing equity, 1,000 profit made, equity with the impact of sale of giving up non-controlling interest, and non-controlling interest now 2,000. That's what I just explained. So what I explained is already given in the problem itself. Then what is the problem? What is the requirement? Okay, now you look at this. You think from entity H point of view. Entity H was showing 10,000, their share 2,000. Now what will happen? This 10,000 becomes 13,000, right? Now, should you show this profit of 3,000 or what will happen to this amount now? 3,000. Okay, if I take out the effectively H limited share net assets now 20% of 11,000. 11,000 because if you take out NCI, net amount if I take out, net assets share of it. It says if you take it as a liability, 10,000 net assets, 1,000 profit or equity 10,000 and 1,000 profit. You don't have a share in NCI. That is not, you have a share only in equity. So 10,000 and 1,000, 11,000, right? So 11,000, if you take it as a 20% share, it becomes 2,200. So increase of 200. What is that increase of 200 exactly? The profit of 1,000 was made, right? You remember? There is a profit of 1,000. This profit of 1,000 is there, right? That is your share 20%. The question is this. Entity S has made a profit by selling their stake. Can the holding company, can the investor recognize that profit? That's the question. How this equity transaction will be recognized in consolidated statement of S Limited, reflect in consolidated statements that uses equity method. So effectively, S Limited share in net assets is now 200 in addition to previous share. Basically, 1,000 rupee profit made by entity S, the middle company, entity H. Can they recognize that profit as their profit? Okay, answer is this. You can read out ultimate summary I will tell you. What is the relationship between investor and associate? We follow equity method. What is equity method? Whatever the associate's profit, the investor will recognize on accrual basis. And more importantly, whatever may be the nature of it. If associate says P&L account profit, investor shows share of P&L, investment to P&L. If associate says OCI, then investor will say share of OCI, investment account debit to OCI. If in associate says other equity, the investor also will say share in other equity. That's what ultimately it is. Now this gain, is it taken to P&L? No, it is not taken to P&L because it is just a changes in equity but not a taken to P&L account. Therefore, entity H recognizes 200 as a change in equity and not change in P&L, that is direct credit to equity. Whatever the associate will do, the same thing the uh, investor also will do it. The same nature continues. Reflect the if it's post acquisition change of net assets, yes, it reflects the investor share of associates. So whatever the nature in which the associate reports, the same nature investor also reports. Associate has taken to other equity, investor also will take it to other equity. Hope you understood. Very known problem, but interesting one, can come in exams. Okay, hope you got it. I'll go to next problem. On 1st of April 2019, Big Limited acquired 35% interest in Dig Limited and achieved a significant influence. Cost of investment is 3 lakh. Dig Limited has net assets of 3 lakh 50. Fair value of those assets is 6 lakh 50. Since fair value of the property equipment is 1 lakh higher than the book value. This property equipment having a remaining life of 8 years. For the financial year 1920, Dig Limited earned a profit of 1 lakh, paid dividend of 11,000. Dig Limited also recognized a share of loss of 15,000 that arose from the remeasurement of defined benefit directly in other comprehensive income. Calculate the big interest at the end of the year under the relevant method. Okay, straightforward problem actually. We follow equity method of accounting. What is equity method of accounting? Cost of investment plus share of profits from associates. Cost of investments will include the amount of goodwill not recognized separately but disclosed. Goodwill included in the cost of investments. Okay. And then uh, share of net profits we add, and whatever the associate nature, the same thing investor also will continue. If associate says P&L account, investor also say P&L account. Associate says OCI, investor also says OCI. And dividend received will be subtracted from investment because it was added earlier. And when you recognize the income on accrual basis, and again if you take dividend, that will have to duplication P&L, so that is dividend is not taken to P&L, but instead subtracted from investment as to that extent money is recovered. And one more point, fair valuation, fair value adjustment, revaluation profit on the date of acquisition, that will be part of net assets, which will have impact on goodwill, pre-acquisition profit. Subsequently, that revaluation will result in incremental depreciation that should be adjusted in the associates as well. So what the format will look like, let me write it simply. You can calculate goodwill. I'll calculate goodwill in the previous one. I'll show the format. So investment in associates or joint venture. You follow equity method. So we'll say cost of investment on the date of acquisition, including goodwill. How much we have to mention? Amount will come in the outer column. Then you add share of net profit, share of profit from associate. Then you subtract incremental depreciation on fair value adjustment, incremental depreciation, and institute call this as share of adjusted profit, adjusted P&L. You need not show, you can show separately also. Then add plus or minus share of OCI, maybe plus, maybe minus share of OCI. And if you receive any dividend, you subtract it, minus dividend receipt. Okay, so that's how the format you have to follow it. Goodwill, some information will be there, sometime may not be there. In this problem, we have information, so we can calculate. So let's calculate goodwill. Simple formula: cost of investment less share of net assets on acquisition. Only for disclosure purpose, not for recognition purpose. Cost of investment 3 lakh. Share of net assets, fair value of net assets 6 lakh 50, 35%. Six lakh 50, 35%, 2 lakh 27 500. So goodwill 72 500. Only for reporting purpose, not for recognition purpose. 72 500. Okay. So cost of investment 3 lakh, including goodwill of 72 500. Okay. Share of profit. Limited earned a profit of 1 lakh. So 1 lakh into 35%, 35,000. Incremental depreciation, fair value equipment higher by 1 lakh. Life is 8 years. So 1 lakh divided by 8. But your share to be taken 35%. So 1 lakh divided by 8 into 35%, 4375, and to be subtracted. So net amount 39,375. Sorry, should subtract, right? Sorry. Sorry. 3625. You can also do in one more manner. Profit was 1 lakh, and this amount 1 lakh by 8 means how much? 12,500. So from 1 lakh, if you take out 12,500, you get 87,500. That 35% you can take it. That's also going to come to the same amount. Share of OCI. There is some remeasurement or defined benefit obligation. Benefit directly taken other commerce income. Loss of 15,000. Loss. So we'll subtract 15,000. 35% share. 5250. So net dividend received also is there. They have declared a dividend of 11,000. Paid 11,000 your share. $3,850. So 3 lakh plus 3625 minus 5250 minus 3850. 2 lakh 6. 3 lakh plus 3625 minus 5250 minus 3850. 3 lakh 21 525 is the closing balance to be reported in consolidated financial statements. This dividend will go to P&L in separate financial statements, but in consolidated financial statements, it will go to the it will be separate from the investment. Okay, so this is one kind of full-fledged problem you can think. Definitely, you can mark it important from exam point of view. It should give a good idea regarding equity method. Okay, so hope you got it. Very good. So that's it for today. Today evening at 9 o'clock, we will meet for any doubt clarifications on Q&A. Tomorrow we'll continue with the next standards. From tomorrow onwards, I'll continue with the regular format in which I follow. That I think financial instruments or business combination. I'll look into it. So from tomorrow onwards, we'll continue same time, 7 to 9. So please come prepared. These are not revision classes, not concept classes. These are upgradation classes. So if you have come prepared, if you have any doubts, you will be able to get clarified as well. And hope these sessions are useful. So we'll join tomorrow. Please join tomorrow at same time, 7 o'clock. Till then, take care. Bye-bye.